Back in the early 1600s, there was this flower, just a flower, a tulip bulb in the Netherlands that at its peak could cost you the equivalent of a canal-side mansion in Amsterdam. I'm talking about 10 times what a skilled craftsman made in an entire year. For a flower. One single bulip. Now, you might be sitting there thinking that's insane, and you'd be right. But here's what really happened that nobody talks about. It wasn't the tulips themselves that created the mania. It was something far more dangerous. It was the belief that there would always be someone willing to pay more tomorrow than you paid today. And when that belief shattered in February 1637, fortunes evaporated in days. Entire families were financially destroyed. But here's the kicker that history books gloss over. The people who actually grew the tulips, the farmers with the land and the knowledge, they survived just fine. It was the speculators, the people chasing price appreciation without understanding what created actual value, who got obliterated. My name is David, and I spend way too much time thinking about how most people are building their retirement plans exactly like tulip speculators, hoping their portfolio will be worth more when they sell than when they bought, without ever asking what's actually creating value underneath. If you're someone who's tired of being told to dump money into index funds for 30 years and pray the market keeps going up, or if you're realizing that traditional retirement advice feels uncomfortably similar to a Ponzi scheme where you need new buyers to cash out, subscribe and like this video. It will help more than you think. By the end of this video, you'll understand the exact mechanism that lets certain investors replace their salary years or even decades before traditional retirement, and why the financial services industry has spent billions convincing you it's too risky or too complicated for regular people to attempt. I'm going to show you why the entire concept of saving your way to retirement is actually the risky path, not the safe one. And I'm going to walk you through 3 specific assets that generate income right now, today, this month, not 30 years from now when you're hoping to sell them to someone else. So let me take you back to that tulip situation, because understanding what happened in the Netherlands in the 1630s is going to unlock everything about why most retirement advice is designed to fail you. Here's what actually went down. In the early 1600s, tulips were exotic, newly imported from the Ottoman Empire. They were a genuine luxury item, a status symbol for wealthy merchants. Owning rare tulip varieties in your garden showed you had made it. That part makes sense, right? Supply was limited, demand from wealthy buyers was real, prices went up, normal market dynamics. But then something shifted. Tavern owners and regular traders realized they could buy tulip futures, essentially contracts promising delivery of bulbs that hadn't even been harvested yet. You didn't need to actually care about tulips. You didn't need a garden. You didn't need to know anything about horticulture. You just needed to believe you could sell that contract to someone else before you had to actually take delivery and pay for the physical bulb. So here's what happened next. Prices started climbing, not because tulips became more useful or more beautiful, but purely because speculation created its own momentum. A bulb that cost 50 guilders in October would cost 200 guilders in December. Not because anything changed about the tulip, but because traders believed they could flip the contract for 300 guilders in January. Notice the pattern? Nobody was buying tulips to enjoy tulips. They were buying contracts to sell contracts. The entire system required a constant supply of new buyers willing to pay higher prices. Step 1. Exotic item with real scarcity and real demand. Step 2. Financial instruments created that separate ownership from actual use of the item. Step 3. Speculation drives prices based purely on expectation of future price increases. Step 4. The scheme requires infinite new buyers, which is mathematically impossible. Now, here's where it gets really interesting. In February 1637, something broke. Some historians think it was a particularly bad outbreak of bubonic plague that made people realize gathering in taverns to trade flower contracts might not be the best use of their remaining time on Earth. Others think a few large buyers simply failed to show up at an auction, but the specific trigger doesn't really matter. What matters is that one day, sellers outnumbered buyers. Prices dropped 10%, then 20%. Panic set in. Within a week, tulip bulb contracts lost 90% of their value. People who had mortgaged their homes, their businesses, their workshops to buy tulip contracts were completely ruined. We're talking about financial devastation that echoed through families for generations. Merchants declared bankruptcy. Entire trading houses collapsed. But here's the part that should make your ears perk up. The actual tulip growers, the farmers who owned land and knew how to cultivate bulbs and had real customers who wanted tulips for their gardens, they were fine. They took a hit, sure. Prices came down from the insane speculative peaks, but they still had land, they still had knowledge, they still had customers who valued tulips, not as trading tokens. They had income-generating assets. They had productive capacity. They weren't relying on finding a greater fool to sell to. They could weather the storm because their wealth was tied to something that produced value, not something that required perpetual price appreciation. So what does this have to do with replacing your salary in retirement? Everything. The traditional retirement path you've been sold is the tulip speculation path. You're told to buy index funds, which are just baskets of stocks, and hope that when you're 65 or 70, there are enough younger workers buying into their own 401ks to keep pushing prices up so you can sell at a profit. You're not buying income. You're buying the hope of price appreciation. You're buying a contract you hope to sell to someone else for more money later. You are, whether you realize it or not, a speculator hoping there's a greater fool behind you. And maybe there will be. Maybe the market keeps going up forever. But that's hope, not a plan. That's speculation, not income. Just like those Dutch farmers who actually grew tulips, the people who retire early and comfortably are the ones who buy assets that produce income, that create value, that generate cash flow regardless of what the market price is doing on any given day. They're not waiting for someone to buy their portfolio at a higher price. They're collecting income every single month from assets that produce value in the real world. Imagine you own a rental property. You buy a house for $200,000. You put down $40,000, you finance the rest. The rent is $2,000 a month. Your mortgage payment, property taxes, insurance, and maintenance average out to $1,500 a month. You're clearing $500 a month in actual cash flow. Now, maybe the house value goes up, maybe it goes down. Maybe the market says your house is worth $250,000 next year, or maybe it says it's worth $180,000. Here's the thing. You don't care as much as someone who's speculating on price because you're not selling. You're collecting $500 a month. That's real money hitting your bank account regardless of what Zillow says your house is worth. If you own 10 of those properties, that's $5,000 a month. That's $60,000 a year in passive income. That might be enough to replace your salary right there. But now you might think, okay, David, real estate, sure. But what if I don't want to deal with tenants and toilets and termites? What if I want truly passive income? And that's a fair objection. Here's where it gets really interesting. There are 3 specific assets you can buy that generate income without you having to manage physical property, without you needing to become a landlord, without requiring you to understand complex trading strategies or spend hours a day monitoring markets. These are assets that produce cash flow, that pay you for owning them, that generate value in the real economy. The first one, and this is my personal favorite, is dividend-paying stocks in companies with long track records of stable payouts. Now, before you roll your eyes and think, I'm just telling you to buy stocks like every other financial talking head, stay with me because the psychology here is completely different. We're not buying stocks hoping they go up in price. We're buying stocks that pay us cash every quarter, regardless of price. Companies like Coca-Cola, Procter & Gamble, Johnson & Johnson, utilities, real estate investment trusts structured as corporations. These are boring companies that make boring products that people buy in good times and bad times. Toothpaste, electricity, soap, bandages. These companies generate billions of dollars in free cash flow every year, and they distribute a significant portion of that cash to shareholders as dividends. Let me give you specific numbers so you can see how this actually works. As of right now, today, there are blue chip dividend stocks yielding between 3 and 5% annually. Let's be conservative and say you build a portfolio yielding 4%. If you invest $500,000, that's $20,000 a year in dividend income. That's paid to you in cash, usually quarterly, regardless of whether the stock price went up or down that quarter. You wake up, you check your brokerage account, and there's $5,000 deposited. 3 months later, another $5,000. You didn't sell anything. You didn't time the market. You own a piece of a business that generates profit, and that business shares that profit with you. Now you're asking yourself, okay, but David, I don't have $500,000 sitting around to invest. And that's the point. Most people don't start with a lump sum. But here's the beautiful part about focusing on income instead of price appreciation. Every dollar of dividend you receive can be reinvested to buy more shares, which generate more dividends, which buy more shares. It's a compounding machine. If you invest $10,000 a year into dividend stocks yielding 4%, and you reinvest those dividends in 20 years, you don't just have $200,000, you have closer to $320,000 because of compounding. And that $320,000 is generating $12,800 a year in passive income every single year without you selling a single share. But here's the catch that the financial services industry doesn't want you to focus on. They make money when you trade, when you buy and sell, when you rebalance, when you panic and move money around. They make way more money off of someone who's constantly adjusting their portfolio, chasing performance, than they do off of someone who buys solid dividend payers and just holds them for decades collecting income. The entire industry is built around convincing you that you need active management, that you need to beat the market, that you need complex strategies. But the dirty secret is that boring, steady, dividend-focused investing is one of the most reliable paths to financial independence, and it doesn't require paying some advisor 1% of your assets every year to tell you which hot tech stock to chase. Let me tell you about what happened in the 1970s, because this is the second time in modern history that the investing world forgot this lesson and paid dearly for it. Back in the late 60s and early 70s, there was this group of stocks called the Nifty 50. These were 50 large cap stocks that everyone agreed were such great companies, such dominant businesses, that you could buy them at any price and just hold forever. Companies like IBM, Polaroid, Xerox, Kodak. The idea was that these companies were so superior that valuation didn't matter. Just buy and hold and you'd be fine. Analysts called them one decision stocks. You make the decision to buy, and then you never have to make another decision. So what happened? Investors piled in. Price to earnings ratios went to 40, 50, even 90 times earnings for some of these stocks. People were paying $90 for every $1 of profit the company made. And they felt smart doing it because these were great companies. But here's the thing, valuation always matters. Always. Doesn't matter how good the company is, if you pay too much, your returns will suffer. In 1973 and 1974, the market crashed. The Nifty 50 got obliterated. Stocks that had been trading at 90 times earnings dropped 70, 80, 90%. Polaroid went from $140 a share to $14. Xerox dropped from 170 to 49. People who had bought at the peak saw their portfolios cut in half or worse. But here's what's critical. If you had bought those same companies when they were reasonably priced, when their dividend yields were attractive, when you were being paid well to own them, you would have been fine. The companies didn't disappear. They kept making products. They kept generating cash flow. Many of them kept paying dividends. The problem wasn't the companies. It was the price people paid and the fact that they were speculating on price appreciation rather than buying for income. The investors who focused on dividend yield, who waited for reasonable valuations, who bought when they were getting paid 5 or 6 or 7% dividend yields to own these businesses, they did just fine. They collected their dividends through the crash and came out the other side wealthier. This is where the psychological shift happens. When you own a stock purely for price appreciation, every market dip feels like a crisis. You're losing money, your net worth is shrinking. You panic. You sell at the worst possible time. But when you own a stock for income, for dividends, a market dip is just noise. Your dividend didn't change. You're still getting paid the same amount every quarter. In fact, if the price drops, you're kind of happy about it because now you can reinvest your dividends and buy more shares at a cheaper price, which means even more income in the future. The emotional experience is completely different. You're not riding a roller coaster of fear and greed. You're collecting a paycheck from the businesses you own. Now, the second asset class you can buy to replace your salary is bonds, but not the way most people think about bonds. Most financial advisors will tell you to own bonds for safety, for diversification, for ballast in your portfolio. And sure, bonds are generally less volatile than stocks, but that's not why we're interested in them. We're interested in bonds because they're literally contracts that require the borrower to pay you interest. You're lending money to a corporation or a government, and they're contractually obligated to pay you a fixed interest rate, usually twice a year, until the bond matures and they give you your principal back. Let me make this concrete. Right now, you can buy investment-grade corporate bonds yielding between 5 and 6%. Let's say you buy a bond from a solid company, something like Verizon or Home Depot, yielding 5.5%. If you invest $100,000, you receive $5,500 a year in interest payments. That money shows up like clockwork. It's not dependent on the stock market. It's not dependent on economic growth. It's a contract. They owe you that money. As long as the company doesn't go bankrupt, which is unlikely for a large, stable, investment-grade corporation, you get paid. Now, you might be thinking, okay, but 5.5% doesn't sound that exciting compared to the stock market's historical 10% average annual return. And you're right, if we're talking about total return, including price appreciation. But remember, we're not focused on price appreciation. We're focused on income you can spend without selling anything. The stock market's 10% average includes years where it's up 30% and years where it's down 20%. The volatility is enormous. And most of that return is from price appreciation, not income. The dividend yield on the S&P 500 right now is only about 1.5%. So if you need income, if you need to replace your salary, you'd have to sell shares to generate cash flow, which means you're slowly liquidating your portfolio and hoping it lasts. Bonds flip that script. You get 5, 6, even 7% annual income on certain bonds paid in cash without selling anything. Your principal stays intact. And when the bond matures in 5 or 10 or 20 years, you get your original investment back, assuming the company is still solvent. You can then reinvest that principal into new bonds at whatever the prevailing rates are. This is how pension funds work. This is how insurance companies work. They match their obligations, the money they owe to retirees or policyholders, with bonds that pay predictable income. It's boring. It's not sexy. You're not going to brag to your friends about your bond portfolio, but it works. Here's a specific example of how you could structure this. Let's say you need $40,000 a year to replace your salary. You build a portfolio of $700,000 in investment-grade corporate bonds yielding an average of 5.7%. That's $39,900 a year in interest income paid to you in cash. You don't touch the principal. You live off the interest. If you want to be extra conservative, you take half of that interest income and reinvest it to keep pace with inflation, and you live off the other half. Either way, you've created a personal pension that pays you every single year without requiring you to sell assets or hope the market goes up. But here's the catch, and this is important. Bond prices move inversely to interest rates. When interest rates go up, bond prices go down. When interest rates go down, bond prices go up. So if you buy a bond yielding 5% and then interest rates jump to 7%, the market value of your bond will drop because new bonds are now more attractive. Does that matter? Only if you're planning to sell the bond before it matures. If you hold the bond to maturity, you get your principal back, regardless of what happened to the price in the meantime. This is another psychological shift. You have to stop thinking like a trader who's watching prices every day and start thinking like a pension fund manager who's matching income to obligations. The people who got crushed in bonds in 2022 and 2023 were the ones who bought bond funds expecting price appreciation, or at least price stability, and then panicked and sold when rates spiked and prices dropped. The people who bought individual bonds with the intention of holding to maturity and collecting the interest payments, they were fine. In fact, they were better than fine because now they can reinvest their maturing bonds at higher rates and get even more income. Now, the third asset, and this is the one that I think is most misunderstood and underutilized by regular investors, is real estate investment trusts, specifically publicly traded REITs. These are companies that own income-generating real estate. Office buildings, apartment complexes, shopping centers, warehouses, medical facilities, cell phone towers, data centers. The structure of a REIT is beautiful for income investors because by law, they have to distribute at least 90% of their taxable income to shareholders as dividends. They don't have a choice. It's baked into the tax code. If they want to maintain the REIT status and avoid paying corporate income tax, they have to pay out almost all of their profit. What this means is that REITs typically have dividend yields way higher than regular stocks. We're talking 5, 6, 7, even 8% in some cases. And these aren't speculative startups. These are companies that own billions of dollars worth of real estate that generates rental income every single month. Think about it. You own shares in a REIT that owns 200 apartment buildings across the Sun Belt. Every month, thousands of tenants pay rent. That rent money flows to the REIT. The REIT pays its expenses, property taxes, maintenance, debt service, and then distributes the remaining cash to you and the other shareholders as dividends. Let me give you a specific example. There's a REIT that focuses on medical office buildings, doctor's offices, outpatient clinics, dialysis centers. These are properties with long-term leases to healthcare providers. Healthcare is not a discretionary expense. People need medical care in good economies and bad economies. This particular REIT has been paying dividends for over 20 years, and the current yield is around 6%. If you invest $200,000, you receive $12,000 a year in dividend income. That's $1,000 a month. You didn't have to find a property, negotiate a purchase, deal with a bank, find tenants, fix a leaky roof, or evict anyone. You bought shares in a professionally managed company that does all of that for you, and you collect your share of the rental income. But now you might think, David, what about the risk? What if the real estate market crashes like it did in 2008? And that's a fair question. Here's the thing. Not all real estate is created equal. The REITs that got destroyed in 2008 were the ones heavily leveraged and exposed to risky property types or development projects. The REITs that owned essential real estate with creditworthy tenants and conservative debt levels, they had a rough couple of years. Sure, dividends got cut in some cases, but they survived and came back stronger. And here's the key. They never stopped generating rental income. The buildings didn't disappear. The tenants, especially in sectors like healthcare or essential retail or industrial warehouses, kept paying rent. This is the difference between owning productive assets and owning speculative assets. A productive asset generates income from real economic activity. A speculative asset only makes money if someone else is willing to pay you more for it than you paid. REITs are productive assets. They own real buildings that real businesses rent to conduct real commerce. As long as the economy exists, as long as people need places to live and work and receive medical care and store goods, those properties have value and generate income. Let me take you back to another historical moment that illustrates this perfectly. In the early 1980s, inflation was running over 10% a year. The Federal Reserve, under Paul Volcker, jacked interest rates up to nearly 20% to kill inflation. 20% interest rates. Mortgages were 15, 16, 17%. The economy went into a brutal recession. Unemployment spiked. The stock market struggled. Real estate prices stagnated or fell in many markets. It was a terrible time to be a speculative investor hoping for price appreciation. But you know who did okay? People who owned income-generating real estate. Rents kept pace with inflation. In fact, rents went up because inflation was high. If you owned an apartment building and your mortgage was fixed at 8% from a few years earlier, and rents were now going up 10% a year, your cash flow was increasing, even though the market value of the property might have been flat or down. This is the magic of productive assets during inflationary periods. The income adjusts upward with inflation, but your debt, if it's fixed rate, stays the same. Your real debt burden actually decreases because you're paying it back with inflated dollars. Meanwhile, people who had their money in bonds or savings accounts or cash were getting destroyed by inflation. Their purchasing power was evaporating. But real estate owners, people with hard assets generating income, they were protected. The asset itself was a hedge against inflation. So here's how you put all three of these assets together. You build a diversified income portfolio. Let's say you have $1 million to invest. You put $400,000 into a portfolio of high-quality, dividend-paying stocks yielding 4% on average. That's $16,000 a year. You put $300,000 into investment-grade corporate bonds, yielding 5.5%. That's $16,500 a year. You put $300,000 into a diversified mix of REITs, yielding 6%. That's $18,000 a year. Your total annual income is $50,500. You haven't sold a single share. You haven't touched your principal. You're living off the cash flow generated by productive assets. Now, you might not have $1 million right now. Most people don't. But here's the beautiful part. You can start building this income stream with whatever you have. You invest $10,000, you're generating maybe $400 or $500 a year in income depending on your mix. You reinvest that income to buy more assets, which generate more income. You add new money from your salary every month. Over time, the income grows. In 10 years, maybe you're generating $10,000 a year in passive income. In 20 years, maybe it's $40,000 a year. At some point, that income exceeds your expenses, and you have a choice. You can keep working because you want to, not because you have to. Or you can retire early, live off your income, and spend your time however you want. This is the path that almost nobody talks about because it's not exciting. It doesn't promise overnight riches. It doesn't involve trading options or buying crypto or flipping houses. It's boring. It's slow. It requires patience and discipline. But it works. And the reason it works is because you're not speculating. You're not hoping to sell to a greater fool. You're buying ownership in productive assets that generate real economic value and share that value with you in the form of cash income. Now, here's where I need to be really direct about who benefits from you not knowing this. The financial services industry makes billions of dollars a year from management fees, trading commissions, and complex financial products. The average actively managed mutual fund charges about 1% of assets per year. If you have $500,000 invested, that's $5,000 a year in fees. Over 30 years, assuming reasonable growth, that 1% fee can cost you hundreds of thousands of dollars in compounded returns. And what are you getting for that fee? In most cases, performance that doesn't even beat a simple index fund. But here's the thing. If you're building an income portfolio with individual dividend stocks, individual bonds, and REITs, you don't need to pay someone 1% a year. You can buy these assets yourself through any online brokerage with zero commissions. You can research dividend stocks for free using publicly available information. You can buy bonds directly or through low-cost bond ETFs. You can buy REIT shares just like any other stock. The entire strategy can be executed with minimal costs, which means more money stays in your pocket, generating more income. The industry doesn't want you to know this because they lose a customer. They lose someone paying fees year after year. So instead, they push products that sound sophisticated. Target date funds, balanced funds, managed portfolios. annuities, variable universal life insurance with investment components. All of these products have layers of fees built in, and all of them are designed to keep you dependent on the financial services industry. I'm not saying all financial advisors are bad or that these products never make sense. I'm saying you need to understand what you're paying for and whether it's actually adding value. Let me give you a specific tactic they use to obscure the truth. They talk about total return, which is price appreciation plus dividends. And they show you charts of how your portfolio would have grown over 30 years. And those charts look great. You see this line going up and to the right, and you feel good. But what they don't emphasize is that most of that return is unrealized. It's on paper. It's only real if you sell, and when you sell in retirement, you're slowly depleting your principal. If you have $1 million and you need $40,000 a year to live, and your portfolio grows 5% a year on average, you can withdraw 4% a year and theoretically never run out of money. That's the famous 4% rule. But here's the problem with the 4% rule. It assumes average returns, but markets don't deliver average returns in a predictable sequence. If you retire right before a major market crash, like in 2000 or 2008, and you're withdrawing 4% a year while your portfolio is down 30 or 40%, you're selling shares at depressed prices and you might not recover. This is called sequence of returns risk, and it's a real danger for retirees who are relying on selling assets to fund their lifestyle. Compare that to an income-focused strategy. If you're generating $50,000 a year in dividends and interest, and the market crashes and your portfolio value drops from $1 million to $700,000, does it matter? Not really, because your income didn't change. The companies you own are still paying dividends. The bonds are still paying interest. The REITs are still collecting rent. You're not forced to sell anything at depressed prices. You just keep collecting your income and wait for the market to recover. The psychological and financial resilience is completely different. So what should you do today, right now, to start building this kind of income stream? First, open a brokerage account if you don't have one already. Use a low-cost online broker, Fidelity, Schwab, Vanguard, any of the major players. Don't pay commissions, don't pay account fees, just a basic brokerage account. Second, start researching dividend stocks. Look for companies that have paid and increased their dividends for at least 10 consecutive years. These are called dividend achievers or dividend aristocrats, depending on the length of the streak. These are companies with proven track records of generating consistent cash flow and sharing it with shareholders. Third, look at their payout ratios. This is the percentage of earnings they pay out as dividends. You want this to be sustainable, generally below 70 or 80%. So the company has room to maintain the dividend even if earnings dip temporarily. Fourth, check the dividend yield. You want something reasonable, typically between 3 and 6% for established companies. If a yield looks too good to be true, like 10 or 12%, it probably is. That's often a sign the market expects a dividend cut. Fifth, buy a small position. Don't bet the farm on your first investment. Buy 10 shares, 50 shares, whatever fits your budget. Start getting comfortable with the process of owning individual stocks for income. Watch the dividends come in, reinvest them, add more money over time. Sixth, do the same thing with bonds. Research investment-grade corporate bonds. Look at the yield, the maturity date, the credit rating. Buy a bond, hold it to maturity, collect the interest, reinvest it, or spend it, depending on where you are in your journey. Seventh, research REITs. Look at what type of properties they own. Look at their dividend history. Look at their debt levels and occupancy rates. Buy shares in a few different REITs across different property types to diversify. Maybe one focused on apartments, one on industrial warehouses, one on healthcare facilities. Eighth, track your income. Create a simple spreadsheet that shows every dividend and interest payment you receive. Watch that number grow month by month, quarter by quarter. This is your passive income. This is what's going to replace your salary. Ninth, be patient. This is not a get-rich-quick scheme. This is a build wealth steadily over time plan. You're planting seeds that will grow into trees that produce fruit every single year. It takes time, but the fruit is real and it's predictable and it's sustainable. 10th, ignore the noise. The market will go up and down. Financial media will scream about crashes and rallies and the next hot stock. None of that matters to you. You're not a trader. You're an income investor. You're building a portfolio of productive assets that pay you regardless of market sentiment. Here's the thing that most people never internalize. Wealth is not a number on a screen. Wealth is cash flow. Wealth is the ability to cover your expenses without having to work. You can have $1 million in a retirement account and still be broke if you're too scared to spend it, or if you're forced to sell at the wrong time. But if you have $40,000 a year in passive income from dividends, interest, and rents, you're wealthy even if your net worth on paper is lower because you have freedom. You have options. You're not dependent on a job or a boss or the stock market cooperating with your retirement timeline. This is the mental shift that changes everything. Stop thinking about accumulation and start thinking about income. Stop asking how much your portfolio is worth and start asking how much income it generates. Stop comparing yourself to people with bigger account balances and start comparing your passive income to your expenses. When your passive income exceeds your expenses, you're financially independent, period. Doesn't matter if you're 35 or 55 or 75, doesn't matter if the stock market is up or down, you've won the game. And here's the final piece that ties it all back to those Dutch tulip farmers. The people who survived the tulip crash were the ones who owned productive assets. They had land, they had knowledge. They had customers who valued the actual product, not the speculation. The people who got wiped out were the ones who owned contracts, who owned pieces of paper representing the hope of future price increases. They had nothing real. When the music stopped, they were left with worthless paper. The same dynamic plays out today. The people who will thrive in the next crash, whenever it comes, are the ones who own productive assets. Companies that make products people need. Real estate that people live in and work in. Bonds backed by the productive capacity of corporations and governments. These assets generate value in the real world. They produce income. They don't require an endless stream of new buyers to maintain their value. The people who will get hurt are the ones who own purely speculative assets. Stocks they bought just because they went up. Crypto they don't understand. Meme stocks they bought because of social media hype. Real estate they bought purely for price appreciation in markets they don't understand. These are tulip bulbs. They only have value if someone else is willing to pay more. And when sentiment shifts, when the greater fools stop showing up, the value evaporates. So choose wisely. Choose to be the farmer, not the speculator. Choose to build a portfolio that pays you, that generates income, that produces value. Choose boring, steady, predictable cash flow over exciting, volatile, hope-based price appreciation. Choose to replace your salary with assets that work for you instead of hoping your account balance is high enough when you're ready to retire. Because at the end of the day, retirement isn't about having a big number in your account. It's about having enough income to live the life you want without having to work for money. And the fastest, most reliable way to get there is to buy assets that pay you today, this month, this quarter, every year for the rest of your life. Dividend stocks, bonds, and REITs. 3 boring, unsexy